Hi, and welcome back to the deep dive into Supermicrocomputer, the hardware manufacturer for AI-optimized servers and storage systems. And we can note here that even my own ChatGPT model makes a note here that this base case is conservative. So for example, if Supermicrocomputer sustains the price earnings of 30 in 2029, which I personally would think is probably more likely than the low 24, then the target jumps to $945 instead, which would mean a 2% CAGR, still way too low to be interesting. But it also could be worse, of course. Let's say competition heats up or the AI race just loses steam for some reason, maybe for deglobalization, maybe for anti-competitive measures, maybe for regulation against AI. You never know. What we do know is that there are a lot of things we don't know, which means uncertainty is high, and when uncertainty is high, we should be careful in buying things on hope, on hoping that they will keep a very high growth rate for years and years, and not being subject to, for example, regulation or other troubles. So our conclusion here and takeaway is that SMCI might find itself in a growth to mature transition, and that it's already priced for perfection. It's not priced for this growth to maturity transition. It's not priced for being actually a cyclical manufacturing company that just right now happens to be in a sweet spot. The conservative side of me would refrain from investing in Supermicrocomputer. I kind of sense it being the Cisco of today. Cisco, remember, 25 years ago, it was the darling of the stock market. It was the largest and highest priced company of the day, and they made internet routers. Making internet routers in the year 2000, that was exactly the same as making storage systems and servers for AI companies today. It's the backbone, it's the picks and shovels. But of course, it's still just like bending metal and screwing it together. It's not really rocket science, and competition is likely to heat up. Especially if everybody's looking for volume. Then again, it could be like TSMC, Taiwan Semiconductor Manufacturing Company, that this is still pretty early in their run. So things are not in any way decided here. But what is decided, I think, is that this is not a huge margin of safety value bet. This is a hope on this being a super company. It's just the beginning of a super company, and I don't think we have enough evidence for that. So the stock is not cheap by TIC standards. My own model says exactly what I would have said, and the best case according to my TIC model is that this is just a flat company, maybe with some kind of a optionality embedded in it, that it could become good, but it also could be of course be something of a loser. But what I think is that looking at the stock price in itself, remember the 200-day moving average, is that it looks like the stock is preparing for an upward leg. And I can see definitely what would propel it to go up again. One, you have a pretty recent memory of the high stock price at 130 and now only at 48. And you actually have NASDAQ at highs again, the same highs that were prevalent when the stock was at 130. So just everything else equal, the stock could be at 130 rather than 48. Well, maybe except for that, you remember the note where they had lowered their forecast. Now, I don't know why they lowered their forecast. If it has anything to do with competition, then I would be worried. But if it's only due to some temporary factors of perhaps delivery or components or shipping, something like that, then I actually would think that a company like this, involved in the absolute sweet spot of the market where all the companies building out AI centers are just scrambling to get hold of components, and they want to get the best components, the best AI optimized servers and storage systems. I would kind of expect this company to start producing surprising results on their quarterly earnings and sales numbers, especially after doing a guidance reduction like they've just recently done. But again, there's always nuance to everything. One time, that's nothing. I mean, they've lowered guidance once. But what if they were to lower guidance again? Then now that would be a wake-up call to the market and to investors. Because missing guidance twice, that means that there is something that the management is not aware of. They have then lost their initiative, they have lost the lead. So that is the kind of risk we have to realize that we are taking in a company like this. So we're now at the risk assessment part. So it's a hardware producer, it's in a very competitive environment, it's currently in a boom phase, which is usually not a good place to invest. People usually overpay when you're in a boom phase. But perhaps this actually is early days for AI build-out. I actually suspect that we will need many years of much bigger systems before we ever get to some kind of anything similar to general intelligence, artificial general intelligence. And it's also a fact that the stock has come down from the boom phase, which means that this could really actually be a good dip to buy into. To summarize, I would say that the case for SMCI would come down to a judgment of their competitive strengths, because I think we have a good backdrop. We have a continued high demand for their type of products. But I have no clue of the particulars for SMCI. I have no idea of why do they have a competitive advantage right now? How difficult is it to attain that? Could there be Korean or Japanese or Chinese manufacturers that are catching up to SMCI? So I personally, I have a high risk of making poor forecasts, and my base case points to 0% return for 4 years, which is like a really bad prospect. But for the short term, remember, now we are dividing a bit from my usual value-oriented, high margin of safety type of investments. Anyway, for the short term, I think the technical setup looks really, really good. And if you like the idea of a stock with where the base case is, well, you're not going to lose any money, and you actually have the optionality here, or the potential at least, of a couple of quarters where it comes back from its guidance reduction and starts producing positive surprises, and there could be a catch-up momentum effect where investors become enamored with the company again, and then taking aim at the most recent highs, then this could be a really interesting momentum play. But again, remember, that would not be the typical deep dive P equals F times V value oriented recommendation.